Hey everyone, Eric Dutram here with the latest edition of the Dutram Report, the podcast on ETFs and more. Today we're taking a look at the world of yield, but we aren't just looking at dividends as we're taking a more holistic approach to this concept with the idea of shareholder yield. To walk us through this in today's podcast, we have Meb Faber, the CIO of Cambria Investment Management, someone who's actually written a book on this topic too, called Shareholder Yield, A Better Approach to Dividend Investing. So if you have any questions or comments, make sure to send them in to podcast@zacks.com. And don't forget to find the Dutram Report on iTunes and give us a review there as well. But stay tuned for my chat with Meb right after this. Okay, thanks for joining us today, Meb. So you're here to talk about the concept of shareholder yield and how this might differ from traditional dividend investing. I wanted to start by asking about the general trend in dividends, because it seems like fewer and fewer companies are paying out dividends these days. And many of the most popular names out there, be it, your Teslas, Amazon, Facebooks of the world, they don't pay dividends at all. So do you think dividends have kind of fallen out of favor here?
First of all, thanks for having me. It's great to be here. And look, everyone loves dividends. Dividends are one of the most storied investment styles, investing in dividend companies and high-yielding dividend stocks, as long as back as we can remember. And historically, investing in dividend-paying companies as well as high yielders has outperformed the broad market. But any astute analyst or portfolio manager has to always question, has anything changed? And understand why any particular factor like dividend yield may work. And so looking back at history, dividend yield is a factor that works because it gives you a value tilt. It's actually not particularly a good value tilt, but it tilts you towards value stocks and away from the broad market cap marketplace. But if you look at the last 20, 30 years, really starting in the early 1980s, the U.S. government approved some rules that allowed companies safe harbor from purchasing their own stock. So what you've seen, a little bit of a difference in the way that companies distribute their cash flows. And so there's only 5 ways a company can actually use their cash. And so dividends being one of them, also buybacks being another one, paying down debt, reinvesting in the business, and then mergers and acquisitions. But historically, companies, had paid out most of their cash flows through dividend route, but that really started changing in the early 80s. And so over the past 30 years, but particularly in the last 10 and 20 and starting in the late 90s, companies have actually bought back more stock than they've paid out as dividends. And Finance 101 tells you that paying out a dividend and buyback is the exact same thing, with ignoring a couple things like taxes and also the intrinsic value of a stock. So you really have to incorporate the other distribution methods to really get a more holistic view of a company, and that's something that we call shareholder yield.
Yeah, and so you look at all 5 of these areas. Is that how you think is a better way to find the true yield of a company?
Well, the big muscle movement, if you're looking at cash distributions, is dividends and net stock buybacks. And you really have to look at net buybacks because a lot of companies out there, think of the tech companies you hear about in the news, will often issue a bunch of stock for options or employee compensation and then buy back on the other hand. And really, it's only sort of a net zero. So you really want the companies that are buying back more shares than they're issuing. But it turns out, if you look at the history, and you can take this back all the way to the 30s, but it really matters most since the 1980s. And if you look at this more holistic measure, investors don't care so much about how the company distributes cash. So if it's a 7% dividend yield, if it's a 7% buyback yield, or it's 3.5 each, people don't really care. It's more of that holistic cash flow measure. And then one more caveat on top of this is we think it's really important to use valuation as well, because the last thing, of course, you want is an expensive company paying out dividends or buying back stock. So if you combine the two, you've historically had much stronger returns in the market in almost every decade going back to the 1920s.
So before you had mentioned that the focus on dividends for investors in the year past has resulted in more of a value tilt. Is this shareholder yield strategy kind of taking that to the next level in terms of even tilting more towards value?
It does, and it tilts more particularly towards cash flow. So if you look at the metric of price to cash flow, which historically has been a great factor, it's pretty highly correlated. And then the problem with you're just looking at dividend yield is historically that often puts you in companies that aren't particularly healthy. They're either paying out a lot of their earnings as dividends or they're highly leveraged. So including other factors, so buybacks being one, but also including valuation. I mean, look, Buffett, the biggest value investor on the planet, loves buybacks. And he says, if all things given equal, and if the company's trading at a discount to intrinsic value, there's no better use for cash than to buy back stock. But the key word being, is that company buying back below intrinsic value? Because what you see is a lot of CEOs out there, of course, that are confident. Every CEO on the planet thinks his stock's undervalued. So you find companies that are buying back stock that are very expensive. So you need some sort of objective or quantitative measure to say, is this stock reasonably priced and buying back its own shares? Then historically that's shown to be a really strong value investment.
So will investors who are just looking for income be disappointed by this strategy? I mean, what kind of payouts do you see from this approach on the income side?
Well, let me give you an example. So say the S&P right now, let's call it a 2%, 2.5% dividend yield ballpark, right? That's kind of in line with bonds, a little bit higher, maybe up to 3%. If you do a high yield strategy, maybe you get to 4%. But you can go type in any dividend fund ticker into Morningstar, and it'll show you the characteristics of that fund. And so we say particularly right now, this is why this is so interesting. So you've had this environment since 2000 where there's been a search for yield. As interest rates have come down, as the Fed has lowered interest rates, almost everyone out there is searching for income. And so one of the best places has been to invest in high-yielding dividend stocks. And if you remember back to the 2000 bear market, dividend stocks didn't even have a bear market. They sailed right through 2000, 2003. So more and more people going into dividend companies. And dividend stocks, the high yielders, have historically traded at about a 20% discount to the overall market going back to the 1950s. And that waxes and wanes. It hit its highest discount ever in late 1999, where dividend stocks traded at a 50% discount to the overall market. Well, this huge rush and all these flows into dividend stocks has pushed all these companies to not only are they no longer trading at 20% discount, they're actually trading at a value premium to the overall market for the first time ever in the past few years. So we've often been warning people away from these dividend companies, which historically a lot of people see as safe. They're producing cash flow, when in reality, you're getting a low income yield, but also paying up a very high price for it. But if you look at the shareholder yield basket, again, you can go type in tickers of ETFs or funds into Morningstar, and it'll show you.
Or Zacks.com.
Those companies are, or Zacks, perfect, yeah. And so it'll show you the underlying characteristics of that fund. And so, a shareholder yield methodology, in particular one that we use, you end up with a lot cheaper companies. And so we think going forward, this focus purely on income could be very distracting. And one more comment there is that a lot of the dividend funds essentially have 0 to negative buyback yield. So you may be buying companies that have 2 to 4% dividend yield, but they'll either have 0 buyback yield or actually negative. But you could buy a traditional buyback or shareholder yield fund that may have a lower dividend yield, so maybe it's 1%, 1.5%, but it has, quote, sort of this 5-6% buyback yield. And it's harder for people to really find that data. It's not as traditional, but it's really that holistic yield. So you end up with a total yield of probably 7% for many of these buyback and shareholder yield funds. It's just not as readily apparent. A lot of people, that's changing though. You're starting to see a lot more people talk about the buyback yield as well.
Yeah, and you know what? There's a couple good points in there. One I wanted to focus on was this idea that I think a lot of dividend investors, they seem to be forgetting about the valuations, and we see that a lot with utilities and especially real estate funds over the last couple of years. Huge P's in a lot of these spaces, and that's something I think a lot of investors forget about. But I did want to ask you a little bit about a way to play this strategy in ETF form. I wanted to focus on the shareholder yield ETF. SYLD is the symbol there. So you get about 100 stocks in this portfolio. What's sort of the weighting methodology here?
We look at equal weight. It's, anytime you move away from the broad market cap and you buy a fund, if that fund is not just pure beta, which, like if you're buying the S&P, a lot of these funds you could pay 5 basis points for at this point, which is awesome. But if you're actually looking for something to outperform, it has to make very concentrated bets. And so you want something in our mind that, like we have 100 companies out of the top 2,000-3,000. So it's a very concentrated fund, because a lot of the funds that end up owning hundreds, if not thousands of stocks, it doesn't really give you the chance to look different. Now, so that's good and bad. And there's times it'll look much worse and times it'll look much better. But we think concentrated is really important. So, yeah, we do approximately an equal weight across those companies.
So does the shareholder yield approach produce any sort of sector biases that investors should be aware of?
It can over time, but it's a go anywhere fund. So theoretically, if consumer discretionary has gotten blown out of the water, then perhaps it may look there. And I think it's important to note that we also use valuation as a filter, and so that will obviously give you leanings. Financials in the U.S. look a little bit better. I will make the global caveat that we've been talking the past few years that the U.S. market is one of the more expensive in the world. So we also are of the opinion that a lot of foreign markets are much cheaper as well. So we run foreign funds too. But in general, it will give you sector bias, and we have quite a bit of leeway to make bets in that space if warranted.
But there's no, let's say, financials are just more traditionally better for shareholder yield metrics. There's nothing like that investors need to be aware of, where just over time that space is going to have more candidates for this strategy?
It can be, but again, it changes over time. So, for example, if you think about Charlie Munger says, to look to the cannibals, looking to the companies eating themselves by buying back shares. And through different market cycles, you have different representation. So whereas tech now is a sector that may be a lot more cash flow producing than it was in the 90s, so you have different routes of people buying back their stock. In the financial crisis, you had a lot of companies batten down the hatches. And so particularly a lot of the companies that you wouldn't expect to be huge share issuers and cutting their dividends were. So it changes over the years. I don't know that there's one sort of, like if you were to look at dividends, I would say yes, that's a very clear bias. You end up more in telecom and utilities and other sectors that are tiny overall sectors of the economy. But I don't know that the shareholder yield particularly gives you any very strong bias over time.
Yeah, maybe because it's taking more of that holistic approach as opposed to just looking at one segment, where you might see that in utilities or some of the other areas you mentioned. Maybe that's why it doesn't tend to have this sector bias over the long period.
It's not necessarily sector, but if looking at, say, a country bias, there's a lot of places around the world that don't have the cultural history of buying back stock. So the U.S. tends to be an outlier that buys back much more stock than other countries do. That's changing. You're seeing certain countries and places around the world becoming a lot more shareholder friendly, like places like Japan. And so you're seeing, traditionally those markets that are much higher traditional dividend payers also start to buy back stock. So it changes over time. And I don't know that the world is not gravitating towards a more shareholder friendly approach.
Yeah, let's talk briefly about the foreign fund that you have for this strategy. FYLD is the ticker. Is this basically SYLD, but with companies outside the U.S.?
Yeah, so we actually have two foreign on this strategy. There's FYLD, which is foreign developed, and EYLD, which is foreign emerging. And it's the same general approach. We're looking at the 20 or so countries in each index, applying the same filters, which is, looking at shareholder yield, making sure the valuations are cheap. And two comments there, by the way, is that, a lot of people focus on, hey, I want to buy the cheap companies. I want to buy the best companies that are paying dividends and buying back stock. But it's equally as important for return historically, and that's a good thing, but to also be avoiding, and having that approach also helps you avoid the expensive companies and also helps you avoid the companies that are issuing stock. So it's not just you're buying the best ones and the cheapest ones. That's all good, but you got to remember the big indices will automatically hold the expensive stuff too, and the companies that are diluting you. So by avoiding those, it's also a big push to performance. So yeah, those two also end up the foreign developed and emerging. The emerging is much cheaper on a top-down macro basis, but both are cheaper than the U.S. is currently.
So you mentioned Japan as kind of moving in this more shareholder-friendly environment. What are some other countries that you see that make up a big chunk of FYLD, and is there any reason for why some of these names are at the top of the list?
Well, if you look at the global, here's just a comment on global valuations in general. So if you look from a top-down basis at the world, almost across any valuation metric, and you got to remember, valuation metrics are a very blunt tool as applied to countries and sectors, and they play out over very long time periods. It's not weekly or quarterly or even yearly, but really on the time frame of multiple years on out to 10. But the valuation metrics have been very good at predicting future outperformance across countries over time. And so we did a book on this called Global Value as well. And so looking at the world is today, the U.S. is one of the most expensive stock markets in the world. So that's not a terrible thing. It doesn't mean it has to crash or it's a bubble, but it's on the expensive side. One of the metrics we use is a 10-year PE ratio. But a lot of the foreign countries are cheaper and the emerging cheaper still. But if you look at the cheapest bucket, it's actually a lot of not just emerging, but developed as well. So a lot of Europe, a lot of emerging Europe, a lot of Eastern Europe, a lot of, we talked about over the last couple of years, some of the really bombed out countries like Brazil and Russia. And really starting in the summer of 2016, you started to see foreign started to outperform again. And really historically, U.S. versus foreign is a coin flip. So U.S. versus foreign, it's 50-50 which one outperforms in any given year. But the U.S. has had one of the largest outperformances versus foreign stocks from 2009 to recently in history. And so this has created this huge valuation disparity. And for a lot of people, particularly our American listeners, don't realize the U.S. is only half of the world's market cap. So we often tell people, say, look, at a minimum, if you are a market cap investor, you should invest half in foreign. And no one really does because they have what we call home country bias. They put about 70% in U.S. stocks. But so really starting to look outside of borders and even invest in places like we said, Europe, which is one of our favorites, and particularly emerging Europe, the old pigs, that everyone used to talk about, Portugal and Greece and Spain are probably some of the best places to be going forward.
Yeah, and for the emerging market space, we're seeing a lot, at least in the fund right now, that's exposed to China, South Africa, Taiwan. Was it difficult to find enough quality companies that qualify in the emerging market world, or is there a decent number of choices out there?
I mean, that's the beauty, is that if you look at the U.S., there's thousands of companies, but there's far more companies globally. And a lot of people, they hear that and they say, it creates a little bit of fear. Well, can you trust the numbers in China? Or what about all these other countries? They sound like terrible geopolitical places to invest. My God, think about investing in Brazil, or was basically gone through a Great Depression. Or what about Russia with the geopolitical risk? But we live in a globalized world at this point. U.S. companies get something like 40% plus of their sales from abroad, and all the foreign companies as well have a very large exposure to the U.S. We live in this globalized, sort of just cross-pollinated world. And so our comment is always at that point is that it's not going to get less globalized. And so really you should look for value anywhere. And, that often takes you to places where people would historically see as a little bit scary. But if we look back, the U.S. wasn't always one of the most expensive in the world. It got really cheap in 2009, but it was also super cheap in the early 80s. I mean, it was in a low single-digit PE ratio. So the names and the crisis always change, but that's what usually creates opportunity, and vice versa on the flip side.
Yeah, and is there anything on the horizon, either in the shareholder yield front or any other products from your company that you can tell us about that might be coming down the pike in the future?
We have a couple criteria when launching funds. I have 100% of my net worth, investable net worth, in funds and strategies we run. I think it's really important to have skin in the game. And so we only launch products that, A, we want to invest in, B, that we think are good products at a reasonable price, and last, and that don't exist. So we don't really want to launch products that Vanguard has already done or someone else. And so that we want it to be hopefully something somebody wants. So the last couple products we've actually launched, the theme has been a little more targeting the U.S. in capital preservation. So we mentioned that we think U.S. stocks are expensive. We have one of the longest bull markets of all time at this point, going on 8 years now. It's one of the best performing markets in the world, and think it's probably time to warrant caution. So a couple of the last funds we launched a tail risk fund, which is actually a fund that's more, you think of kind of almost like an insurance vehicle where it's going to have low to almost zero returns, but it owns a bunch of puts on the stock market as well as owning a bunch of U.S. government bonds. And both of those historically have done well when the market does very poorly or is in a bear market. And then the rest of the time, it ends up being often a cost, much like, home insurance or life insurance would be. And under a similar theme, we launched one called Cambria Core, which is kind of a similar thing where it buys 50 U.S. stocks that are of good value, but also uses options, what a lot of people would see as traditional, almost like a collar, where you're selling calls to generate some income and then also buying some downside protection as well. So the theme more recently has been that we've been talking about the last 3, 4, 5 years has been foreign is a much more attractive opportunity. Look around. So we launched a lot of those funds. And then also, hey, start to think of, if you're a U.S. equity investor, start to think of, risk again and protecting your portfolio rather than a long-only exposure.
We'll definitely have to take a look at those products in the near future. But thanks for coming on today to talk about shareholder yield. I think this is a great concept and a very solid look at the topic.
Hey, it's been a blast. Let's do it again sometime.
All right, everyone. That was Meb Faber, the CIO of Cambria Investment Management. You can check out more about their ETFs at cambriafunds.com. There you can see some of the other funds that Meb mentioned beyond the shareholder yield products. So check it out for some more information. Well, hope you enjoyed this edition of the Duchem Report. Make sure to tune in for more interviews and discussions on the world of exchange-traded funds in the future. For my thoughts on the ETF world, make sure to go on over to Zacks.com and check out the ETF Investor Service, which includes my top picks and commentary on the markets. And don't forget to find and review the Duchem Report on iTunes. And if there are any topics you want us to discuss, feel free to reach out at podcast@Zacks.com, my Twitter page @EricDutrem, or leave us a comment on Facebook too. But be on the lookout for a new edition of the Duchem Report each and every Thursday. But until then, for Zacks.com, I'm Eric Dutrem.